Hi, this is Paramdeep from Pristine, and in this session, we'll discuss some of the specific nuances of the project finance sector. As we had discussed in the last tutorial, project finance sector is basically related to financing of long-term projects. So these projects typically could be 20 to 25 years, increasingly those that are related to public services or infrastructure. So we spoke about some of the industries in which project finance is more relevant. So, for example, the oil and gas industry, the telecom, real estate, power. These require huge investment upfront and typically create the infrastructure sector. Again, most of the project financing is based upon complex financial and contractual structures. Typically, what happens is that there is no recourse apart from the SPV, apart from the assets and the revenue pool of the SPV for the lenders. So most of the project finance sector, project financing is typically characterized by complex financial and contractual agreements. Now, some of the key parts where this affects your model. So, for example, this specific nuance of the project finance sector, that it's often long term and large projects. How does this affect your model? Typically, what happens is that when we are creating a model for the project finance sector, since it's going to be a long term project, we need to clearly demarcate the dates when these events happen. So apart from a normal model, your template or the layout for the model would typically have a date part attached to it. So most of the project finance models you would see a mathematics being applied as far as dates are also concerned. Again, since this project has a specific duration, so for example 20 years. So in case your construction period gets delayed, there is a risk of delay in the project. So while we are implementing the layout for the model, we'll make sure that this risk can be incorporated in the model itself. So you need to be very clear about building the layout for such a model, and we'll obviously build that layout in one of the next tutorials and show you how this particular part is taken care of. Now, project finance debt, as I told you, is often non-recourse or limited recourse. That means that you cannot go back to the main entity to take back the money. So all you can do is you can utilize the assets and the revenue of the project or the special purpose vehicle. You cannot go back to the main entity and use that and liquidate their assets to take back the money. So that again needs to be taken care of. So while we are building the model, we need to make sure that as debtors, our interests are protected. So all the debtors and the investors want to protect their own interests. Typically in the model, it's done by implementing a cash flow waterfall model for the debt holders, or by building an escrow account and then creating a reserve account called the DSRA, the debt service reserve account. Again, when we build a model, we will take care of this particular part. Again, the cash flows from the project would come only once the construction is fully complete. So typically, till the point the construction is complete, your revenues are zero. So for example, let's say if you are building a toll road or you are building a building, so let's say it takes you 3 years to build. It takes you 3 years to build, and then you operate it for another 17 years. So when it's being built, typically your revenues are zero, and so this is the construction part and this is the operations part, and all your revenues accrue to you in the operations part. So there is a clear demarcation of construction and the operations part, and clearly while the construction is going on, since your revenues are zero, so you need to appropriately take care of the risk during the construction part. And again, when we are building the model, we need to make sure that these risks are correspondingly incorporated in the model. So again, since the construction period is such a critical period, when we are creating the model during the construction period, we will create a quarterly model. And finally, the financial statements are created on a yearly basis. So we need to consolidate these statements that are quarterly in nature to yearly statements. So again, this is one part that we would take care in the model. Again, since during the construction period, you cannot really pay the interest. So for example, during construction period, what would my revenues would obviously be zero. So again, most of my cost of goods sold would obviously be approximately equal to zero. So again, I could have an interest part. So since I am making an investment in the year zero itself, so let's say I make an investment of $1,000 million, right? And there is a debt part of, let's say, 70%. So I told you most of these projects are heavily levered. So on this 700 million debt, you would obviously have to pay an interest. Let's say if the interest rate is 10%. So my interest would be 10% of the overall debt that I have in the first year itself. So there would be an interest payment due out here, $70 million. So obviously, since you have no revenues, you have no cost of goods sold, so you cannot really pay back the interest while the construction is going on. So this interest is then capitalized back to your balance sheet in the form of an interest during construction, and you pay an interest on that interest. This part is called interest during construction. Again, when we are building a model, we need to make sure that we incorporate this interest during construction in a model. Again, one of the specific nuance is that the entity and the SPV are different. So typically when you are lending to such a project, you need to get the credit worthiness of the project itself. So you need to make sure that SPV has sufficient cash flow to pay back your debt and the interest. Typically, project financing could be for two kinds of projects: greenfield, which is the fresh start of the project, or brownfield project. So you are essentially expanding an existing project. So again, if somebody is buying a brownfield project and then going to enhance that, then your model should sufficiently take care of that part as well. So I do hope that you have understood most of these parts. So long-term nature of the project. Again, long-term nature affects the layout of the model. You need to make sure that your model incorporates this part. Again, since the debt is non-recourse, you need to have a proper waterfall cash flow, waterfall model in place so that the interest of the lenders is protected. Again, since the SPV and the entity are separate legal entities, so you need to ensure that there is sufficient creditworthiness in the project itself so that you don't take undue risk as a lender. Again, I think we've already discussed this, but let me go through this slide in a couple of minutes. So the key difference between project finance and corporate finance is that project finance typically is non-recourse. So you cannot go back to the main entity and then claim money from them. Whereas in corporate finance, you can go back to the main entity and take their money. So that's one part that needs to be taken care of. So when you are creating a model for project finance where the recourse is limited, you need to identify the right pool of assets that belong to you, that you can liquidate to get back your money. So as a project finance analyst, you need to make sure that you identify your pool of assets and the revenue very, very clearly. Again, in corporate finance, you can liquidate the borrower, but in project finance, you are entitled to only the cash, the revenues, and the assets. Again, sometimes you don't even have recourse on the assets, just on the revenue of the project. So you need to make sure that that you identify them very, very clearly. Again, if an SPV is involved in multiple activities, then as a project finance analyst, you need to ring fence your assets. You need to clearly identify them and then put that in the contractual agreement. Again, going forward, what's also being witnessed is that that most of the project finance models are coming up in the form of a PPP, public-private partnership. So essentially, most of the infrastructure projects a few years back were the prerogative of the government. So, for example, let's say to build a road, the government would build the road and give it to you. But going forward, what we are seeing is that that government has started moving away from the from building the roads or building power projects or let's say or going for these activities, and they have started outsourcing the activities to private players. So there is a broad spectrum of investments, and what we are seeing is that when there are no private investments, it's called a fully public sector investment, and when you have no public investment, you have a fully private sector investment. In between them, you could have a large spectrum of cases. So, for example, let's say to build a new road, the government gives out a contract. So let's say a road has to build from A to B. So what the government would say is that you build. So let's say the government of China. So let's say the government of China. What they would say is that a private company, let's say ABC, can build this road. So let's say it takes 3 years to build the road. So this is the construction period. And post that, they can operate this road for 17 years. So then they can operate the road for another 17 years, collect the toll and keep that code and keep that toll. And post that, the road is passed back from ABC to the government of China. So this kind of an agreement is called a concession agreement, where ABC makes all the investments. So they make all the investments. Then they operate this particular asset for a limited number of years, and post that they pass it back to the government of China. So this is called a concession agreement. Similarly, another agreement could be build, operate, and then transfer. So essentially, what the ABC would do is that they would build this road, operate it for a few years, and then transfer it back to the government of China. Now, out here, clearly the investment risk is also being borne by ABC. What you could also have is that the government gives it out as an outsourcing contract. So, for example, let's say in Bombay, in India, they wanted to build the Bandra Worli sea link. So on top of sea, between Bandra and Worli, they built a sea link. So this was built as a public-private partnership, where the government didn't build the road. They outsourced it to, let's say a company called Hindustan Construction Company. So Hindustan Construction Company would build it as per a particular SLA and then transfer it back to the government. So this could be a management service contract or a public contract, where the government doesn't really build the road. They would just make sure that the regulatory compliance is met, and apart from that, they would not do anything else. So this could be the various spectrum. One could be a divestiture, where everything is being done by the private company. The asset ownership is private, the capital investment is private, the O&M, operation and maintenance, O&M is operations and maintenance. And the commercial risk, all are private in nature. They build, operate, and own. Again, everything is private in nature. They build, operate, and transfer. The asset ownership could be for both the parties, but most of the risk is borne by private companies. For a concession agreement, so for example, the road clearly belongs to the government of India or the government of China. It says that the private company is going to come in, build the road, operate it. So bear all the commercial risk, bear all the O&M risk, the capital investment, and then transfer it back to the government. Then there could be a lease agreement where even the capital investment is shared and the commercial risk is also shared. In a management contract, all the risks are basically borne by the government. The private party just comes in and implement the project for the government. So again, if we are speaking about project finance under the PPP mode, the public-private partnership mode, then there are obviously multiple parties involved in the project. So you have the government, who's going to own the project, or who is the private party which outsources the project. Then you have the sponsor of the project who essentially implements the project for you. Then you have contractors who would take the contract from the sponsor and then build it. Then you have the suppliers, and you have the financing companies who come out and then finance these projects. And typically, such project finance deals can take years to negotiate and complete. So there is a huge risk of the project getting delayed and multiple parties being involved. Again, since there are multiple parties involved, so you need to make sure that they are protecting their own interest, which is typically done by putting a specific charge on the capital that's flowing into the project, and everybody wants to protect their own interest. Apart from that, the government or the party which is outsourcing the project might also want to incentivize the operational partner to make sure that they build it on time and they build it well. So they want to incentivize the party to perform. So again, when we are building a model, we need to make sure that all these parts are taken care of in the model. And as we move forward in the model, I'll keep pointing to you each time we implement one of these things in the project, how we are going to implement this specific nuance for the project finance sector. So you need to incentivize the management and then appropriately hedge your risks. So these could be the various risks. So you could have construction time risk, so a risk of the project getting delayed, a risk of the operational cost or the construction cost getting delayed, a risk of not sufficient volume being taken care of. So for example, you build a road between A and B that costs you $1,000 million, right? And then there are not sufficient people ready to travel on this road because of the high toll tax. So again, you need to make sure that that the party's interest is protected. Once this investment is made, there is a sufficient IRR being generated from that investment. Again, then there could be a political risk, a risk of war, hostility, or currency. So since the loan that's coming into the project could be a different currency, so there's a specific currency risk that is there. Again, there could be socio-environmental responsibilities and risk related to socio-environmental responsibilities. Again, if you are building a nuclear plant, a nuclear power plant, or let's say a hydro plant, which is going to affect the social environment of that region, then there is a specific risk, and there could be retaliation from the local people sitting there. Again, I have already spoken about this, so there could be multiple parties involved in the project. So the SPV, you could have the sponsor of the project who is finally going to build the project. There could be host government, which essentially outsources the project or its implementation. Then there could be expert professionals who advise the sponsor or the government on the implementation of the project. Then there could be guarantors who guarantee that if the sponsor is not able to perform, or if the EPC contractor is not able to perform, then they would performance guarantee their performance. Then there could be the purchaser who's going to purchase the final product being implemented or utilize the infrastructure that is being implemented. You could have the supplier who's going to supply the raw material to the EPC contractor or the sponsor. You could have the operator who's going to operate this particular asset that is being built. Then there are lenders and insurers who again make sure that the financial agreements that are built, their interests are taken care of. So typically the SPV is going to implement the project and operate as a separate company. It needs a separate shareholder agreement where the different stakeholders and the shareholders come together and then build this contractual agreement. Again, when you are building the contract, you need to make sure that the costs are taken care of. So this is basically the investment part of the business. You need to make sure that the investment part of the business is taken care of. This is the sales part of the business, where once you have built the business, you need to make sure that whatever infrastructure you have built, there is a sufficient offtake of that. This is the financing part of the business, so you need to make sure that the lenders and the loan agreements are in place, and then everything has to gel together. That's very important. Everything has to gel together to make sure that the SPV functions well and is able to generate the amount of money that it is expected to generate. Again, there could be risks, and these risks have to be built in the model, or they have to be taken care of in the model, so that when you are building the model, you need to make sure that you have a clear understanding of what's happening in the project. So there could be a funding risk in the model. So let's say the project would require, let's say, if it's a large project, let's say $10 billion, and the equity investment in this is going to be, let's say, $3 billion, and you still have to procure a debt of $7 billion. Obviously, this kind of debt usually would require global finances to be there, and in case the SPV is not able to get this kind of funding, the project might be in trouble. There could be regulatory risks. So there's a government change, and the new government that is coming in is not approving the project, or let's say you are unable to get the forest clearance or the environmental clearance. So there could be a regulatory risk to the project. So the project could be very, very lucrative. Let's say if a new nuclear plant is to be built, it could be a very, very lucrative project. But again, there is a huge regulatory risk running in the project, as in case the government is not able to convince the different parties, then such a big project could be in trouble. Again, there could be land acquisition risks. So most of these projects are large projects, and they require huge amounts of lands, huge amount of contiguous lands to build the project. So in case the sponsor of the project is not able to acquire the land, the project could land in trouble. Typically, in real estate projects, if you're building an IT park or one of these large real estate deals, then this land acquisition risk is a huge risk. Then there could be the market risk. You want to sell out your project, or your land, or your or let's say you want to give it out on lease. There is not enough demand in the market. It is a huge risk for the project, and whoever is funding the project could land up in trouble. Again, one important part to note out here is that most of these projects are limited duration projects. So there could be a demand later on. Let's say there could be a demand 25 years down the line. But in case the life of the project is 20 years, so it doesn't matter to the SPV whether there is a demand 25 years down the line or not. You need to get the money today to make sure that the project is viable for you. Again, there could be an execution risk. So whoever is the operating party is not able to build the project in time, or they are not able to build the project as per the stringent requirements. So one obviously is the time, and the other could be the stringent requirements in building the project. So let's say if a nuclear plant is to be built, and the requirements are very stringent in nature, and whoever is building is not able to comply to these stringent requirements. There could be a technology risk. The technology goes obsolete, and you're not able to build it on time. Then there could be explicit political risks. We have already covered that. So in case there is a change in the government, and the new government that's coming in doesn't approve of the project. There could be implicit political risk. So there could be policy risk. Again, a toll or a revenue risk. That's more because of, let's say, an alternate. Let's say you build a new power plant out here in city A, and just in a competing city B, another large power plant is built, and the IRRs of this particular power plant are in trouble. So there could be the risk of competition or substitute being built. Then there could be a regime change. Again, the government changing. There could be cross-border risk, or there could be a risk related to the concession agreement. And honoring the signed contracts. Again, this risk is a relatively smaller risk in case you are signing it in a PPP deal where the government is signing the contract. So how are the risks mitigated? Typically, these risks are mitigated by signing complex contractual agreements with various parties involved. So, for example, the SPV could sign contracts with the sponsors, essentially the shareholder agreement, with the banks, essentially the credit agreement. So this makes sure that your funding risk is taken care of, right? So again, with the suppliers and the off takers, you need to make sure that your execution risk is taken care of, and off takers who are finally going to buy your product, you make sure that the market risk is taken care of. Again, with the contractors, you essentially enter into a construction agreement where you make sure that they adhere to the specific SLAs on the construction part and the operations part. And again, with the government, you try to enter into a concession agreement which is foolproof, so that if there is a specific policy or a regulatory risk, that is taken care of while you are entering into the contracts. Again, with the local laws, you need to make sure that the relevant permits are there. So the point that I want to make sure, the point that I want to make here is that most of these risks are mitigated by entering into contractual agreements, with the various stakeholders, again, you need to make sure that all stakeholders are taken care of, and this could, since you want to make sure that everybody is coming along, this makes the project a risky project, as a lot of parties are involved. So you need to make sure that everybody is happy when the project is being implemented. So we have been speaking about a lot of risks. So the next question, and the obvious question that we want to answer before closing this session, is that why really project finance, and is it really worth it? I can tell you from my experience that the future of large investments is really project finance. So although it is invariably more expensive than raising corporate funding, or the time to implementation is considerably high. Again, the monitoring and the administration is very difficult in project finance as compared to corporate finance, but it has its own advantages. First is that it insulates the sponsors from the project failure. So, for example, let's say if AT&T is putting up towers as an SPV in an emerging country, AT&T as an entity is fully protected. So it insulates the main entity from the project, and that's a big plus for the main entity. Again, there could be restrictions on the main entity on borrowing, which could be taken care of by this SPV, so that the borrowing clearly comes to the SPV and not to the main corporate. Again, you could have this could be viewed as an off balance sheet financing. So in case there's huge borrowing, so I told you that most of the project finance deals, you could have 70% to 90% debt. Now, no corporate or entity would like to take this kind of a huge debt on their balance sheet. So as long as it's an SPV, the corporate could also be more comfortable in taking this risk. Again, as an SPV, all the risks are mitigated, and they want to sell out all the risks to various parties. So they really enter into contractual agreements and make sure that the risks are hedged. So whoever is lending to the party, to the SPV, for them, since the contractual agreements are there, so the risks also tends to get shared. Again, the government is also trying to encourage this. They are giving tax holidays and concessions for this kind of project finance activities. Again, it's more like legislative necessity that's becoming, because the government doesn't have, most of the governments do not have the funds to implement these kind of projects, since they require huge funding. So the government doesn't want to do that on their own, and it's becoming more of legislative requirement. Again, just to summarize this, what we would see in our project finance model that's going to come out of the discussion just now. So most of these projects are long-term projects, and they have a limited life of their own. Unlike corporates, which is an ongoing entity till infinity, these projects have a limited life. So when we are implementing the model, we would make sure that the date is appropriately considered, and the risk of the delay in the model is also taken care of. So when we are building the model, we need to take care of the date mathematics in the project. So this we would take care in the layout itself. Again, the construction, the operations part has to be clearly demarcated. The risk in the construction period is higher, so we would be implementing a quarterly construction period model, and then we would consolidate this to yearly statements. This is just because we want to monitor the construction part very, very carefully. Again, since in the construction period we cannot pay back the interest, it will be capitalized to the balance sheet in the form of interest during construction, and there would be a circular logic out there itself. We would take care of that as and when we come to it. Again, there are multiple parties involved in the SPV. Each wants to protect their own interest. That would be protected by implementing a cash flow waterfall model, or building an escrow account and building a debt service reserve account. And we would make sure that all the parties are incentivized enough to perform. So the operational party, their interests should be aligned to performance. Again, there are huge risks related to the project finance. We would see how these are mitigated in the model, or at least how they are modeled, and a specific what if analysis is done on these risks. Again, taxes are very important in these models. We would see what deferred taxes are, how losses carried forward. And again, we would also try to see the minimum alternate tax regime. Again, this would be specific to countries. We would touch on this as a generalized concept rather than taking up a specific country as a case study. Again, in the balance sheet, till the point the construction is going on, the asset really doesn't become a fixed asset. It is to be built as a cumulative work in progress, and we would see how balance sheet is implemented and how cumulative work in progress is taken care of. I do hope that you got an understanding of what project finance is all about, what the specific nuances in modeling would be for project finance. And as and when we move forward, I would keep pointing to this sheet and telling you when we have implemented this particular concept in the model itself. I do hope that you found this tutorial to be useful. As usual, if you have any questions, feel free to get back to me on paramdeep@edupristine.com. Alternatively, you could also call me on +91 998 9298 0608. I do hope that you found this tutorial to be useful, and I look forward to seeing you in the next tutorial. Thank you and bye-bye.